you can move forward to, let's skip this slide. Let's skip this one and let's get straight to who the land bank is. Thank you everybody for joining us today. I just want to share a little bit about the land bank and the project and this project in terms of our involvement and why we think this is important for us to be a partner in this project. The land bank, as many will know, is a state-owned development finance institution, and our shareholder is represented by the National Treasury of the government of South Africa. In 2002, there was a review of the Land Bank Act, and on your left-hand side, you will see the mandate of the land bank. So it's quite extensive, but fundamentally it's about how do we transform the agricultural sector. So we try and address the racial bias of the past in terms of ownership specifically, and then concurrently try to grow the sector as well as not only the large-scale commercial sector, which we are mostly exposed to, but also to develop small-scale agriculture. And at the bottom of all of this is about contributing to economic growth and food security of the country. We can move on to the next slide. So there you'll see that we also own, as a subsidiary, an insurance company who also has a very keen interest in matters related to the climate, because although insurance is not compulsory for farmers, we have quite a large exposure in terms of our insurance company to the commercial farming sector. Our vision then fundamentally is to become a world-class agricultural development bank. And we have a number of different programs that we pursue this. We can move on to the next slide. As you know, banks and commercial banks, well, even in this case, a development bank is a very conservative institution. So even though we are state-owned with a very clear development mandate, commercial mandate also is important. So the focus on financial sustainability of the bank has become part of the spotlight in the last few years, because the commercial mandate, where there's a lack of financial sustainability, our resort then is to the fiscus, and in South Africa, the fiscal envelope is very small. And getting smaller as the years go by, so the dependence on the National Treasury to support us declines. At the moment, what happens is that the National Treasury provides us with guarantees, but almost all our funding then comes from the private sector. So our primary stakeholder when it comes to funding is the private capital market. So everyone will know this. Agriculture is already a frontline sector in terms of its dependence on the natural environment. And the economic and environmental challenges are very closely connected, making it one of the most vulnerable economic sectors to impacts of climate change. We've already seen this, and it comes in the form of crop losses or production declines, as a result of extended droughts, diseases, insects, and over the last few years, specifically over the last few years, there's definitely been increasing coverage and frequency on these matters. So what happens is that the negative impacts of climate change on a financier is exacerbated or exacerbates an already risky environment. So farming in general is a very risky environment, and all due respect to the farmers who actually undertake the operations, because there's little known beyond the first day of planting. So the increased uncertainty, this has an impact on the farmers' ability to repay their loans. And in many cases, what will happen and is already happening is that climate change is already impacting farm values and on the security or collateral that financial institutions hold. Can we move forward to the next slide, please? The financial institutions, I mean, fundamentally, even though I had indicated they're fairly conservative, they've over the past few years focused mainly on the ability to pay aspect when it comes to credit assessment. So you assess the the financial operations of the farm, and very little emphasis has been on the environmental or the social aspects. But there's an urgent need for financial institutions, specifically banks, to adapt its internal process to account for new risks. Well, they're not new, but they've always been there, but they're gaining prominence, and so climate risks are definitely one of these. In a recent report by the International Institute for Sustainable Development, there are 4 key recommendations that banks should take on board. Is to integrate climate risks in risk management strategies, incentivize adaptation, definitely develop new products and services, and most would are advised to be far more proactive in their approach by focusing financial services that explicitly target women and the most vulnerable when it comes to climate change impacts. Next slide, please. Yeah, so what we've experienced over the last 4 to 5 years is this rising non-performing loans. So farmers are not being able to repay their loans as a result of factors including climate related. Most recently, ratings downgrades by ratings agencies for land banks specifically, even though climate is not highlighted as a central, but definitely directly related. The land bank has been downgraded 4 times in 2020 because there's so many different knock-on effects. If there's non-performing loans, it means that we then start encountering liquidity problems. Liquidity problems then feed on to a lack of confidence in the institution, which then means a withdrawal of funding. A withdrawal of funding then increases the risks in terms of reputational risks. We cannot support farmers, nor can we pay back our loans. This then shifts clients away from us, so there's a loss of clients, loss of business. All of these have compromises the land bank's ability to execute on its mandate. Can we move to the next slide, please? So in this project, and in Colin's words, we are the fellow users when it comes to case study number 1, working collaboratively with the University of Witwatersrand and the CSIR. And fundamentally is that we'd like help in allowing us to gain the appropriate tools and knowledge so that we can incorporate climate risks in our credit decision making. So we want to ensure that our credit assessments are more robust so that we will prevent future increases in non-performing loans. I think that's fundamentally our contribution or our interest in this, is to make sure that we build and improve our credit assessment or risk assessment. So we can move on to the next slide. And our colleagues are also on this call here from Witwatersrand and CSIR, who can also share some of the work that we'll be doing. So fundamentally, it's really about the crop model simulations and how that translates with respect to climate simulations, how that translates into our ability to incorporate this into our credit models. So again, it's really about co-development of an adaptation strategy for our credit models. We can move on to the next slide. Yeah, the main benefits from this is really about improving our risk assessment and credit decision making. And this is, even though this feeds one set of stakeholders in that it will definitely benefit our farming community, it has a far bigger impact in that there are many different stakeholders that are now interested in how a financial institution manages environmental and climate related risks. So we think that the work that we're doing with FITS and CSR will then help us to become a more climate resilient institution, as well as allow us to translate that into new products for our clients to make them become more climate resilient. It does push us and makes us think more clearly about how we look at risks in a financial institution beyond just the profit issues related to risks to the profitability of the bank. We also think that this allows us to engage with a broader group of stakeholders to ensure that the sector is managed in a better way. We can move on to the next slide, please. So the stakeholders obviously when we engage on a regular basis with our shareholder, the National Treasury, they are obviously concerned about the financial sustainability, but they're also currently focusing on developing policies related to sustainable finance. So we looking at more intensive assessment of environmental and social risks to for all financial institutions that would be coming out probably in the next year. The investors in Land Bank's financial instruments, this is the big pension funds and anyone that has surplus funds, they invest in paper. We've seen that almost all of them are now asking for a clear, an interrogation of our environmental and social risk assessments and evidence of what we're doing currently and what we're planning to do in terms of measuring and monitoring specifically climate-related risks. So, as I mentioned earlier on, some of the consequences that as a result of or not accounting for climate-related risks. We see this downgrade that's happened by Moody's. So the next in 2019 in November, Moody's put us on review for a downgrade. And what I did was I extracted the first statement from what they call elevated credit risks. And if you look at risk number 2. This rising physical environmental risks from climate change and sustained drought, which have the potential to disrupt the ability of the bank's customers to repay their loans. So this was one of the key factors that they considered when they put us on review for a downgrade, because part of what they implying in the statement is that we are not measuring or we're not incorporating these risks to make sure that we assess our clients correctly. Such that they will have the ability to repay their loans. And obviously the other main stakeholders for us would be the farmers themselves, farmer associations. And as I mentioned earlier, there are many international institutions that we have become members to, specifically the UNEP FI Principles for Responsible Banking, that obliges us or commits us to ensuring that all our business processes are and policies are aligned to the SDGs and the Paris Agreement. In addition, multilateral funders like the World Bank, the EIB, and KfW all have an interest in how we manage climate risks. So in that respect, this project overall will help us contribute to addressing not only the internal viability or viability of the land bank itself for now and the future, but also to address all different concerns that are now arising from the various stakeholders we have. And I think I will leave it there.